keeps blocking black wealth. We digging deep to free ourselves.
Welcome back to Who Keeps Blocking Black Wealth, the show where we laugh, learn, and build.
And where every week somebody finds out they was them the whole time.
Because around here, they is you. You know this, Harold, and we believe black wealth is biblical.
My wallet still needs deliverance.
Why are you starting already? We're here to talk about money, systems, faith, and the stuff nobody explained to us growing up.
Including the stuff they hoped you'd never ask about.
I'm Dana Mitchell.
You sure are.
Say hi to the people, Harold.
Gas money first.
Lord have mercy. Let's get into it. You probably know by now, it's time to talk about what changed this week and why it matters. The May jobs report came in much stronger than Wall Street expected. The economy added 172,000 jobs, and unemployment remained at 4.3%.
More jobs sound good.
They do.
People working sounds good. Folks getting paychecks sounds good. So why did Wall Street act like somebody died?
Because Wall Street was not only reacting to the jobs, it was reacting to what those jobs could mean for interest rates.
Here we go. Good news is bad news again.
In this case, a strong labor market told investors that the economy may still be running hot enough for inflation to remain a concern. And if the Federal Reserve believes inflation is still too high, it has less reason to lower interest rates. It may even decide rates need to rise again.
So people got jobs, and investors started selling stocks?
Tech stocks in particular. The NASDAQ fell sharply. The S&P 500 broke a 9-week winning streak. Treasury yields rose. And expectations for a possible Federal Reserve rate increase later this year jumped substantially.
Hold on. People found work, bond yields went up, tech stocks went down, and now everybody thinks Jerome Powell's replacement might raise rates?
That's the situation.
Wall Street need counseling.
Wall Street is forward-looking. Investors are rarely reacting only to what happened today. They are trying to anticipate what today's information could mean 6 months, 1 year, or several years from now.
So the market heard more people got jobs and translated it into money might stay expensive.
Now you're paying attention. Remember back in the Bank Ain't Your Friend episode when we discussed how the Federal Reserve does not directly set your mortgage rate, your credit card rate, or your auto loan rate.
Right. They move the overnight rate, and everybody else start rearranging the furniture.
That's the part of which people must remain cognizant. The Fed influences the cost and availability of money, then banks, bond markets, mortgage lenders, credit card companies, and investors respond based on what they think comes next. So when that jobs report came in stronger than expected, Wall Street wasn't just reacting to more people working. It was reacting to the possibility that money could stay expensive longer or become even more expensive.
So what you're telling me is I just can't listen to an episode and file it away. Just like school, everything is interconnected. But more jobs still sounds good.
For workers, they can be. For markets waiting on lower interest rates, that same news can create a completely different reaction. For regular folk, the return they receive on savings and other fixed income products may fluctuate as well.
Meaning the same interest rate decision can help one person and hurt somebody else.
That is the part people miss. The impact depends on what you own, what you owe, what structure holds your money, and what that structure was designed to do.
So this is where the garages come in.
We're getting there. Because last episode, we talked about location. Let's call them Taxable City, the partially taxed suburb, and tax-free land. This week, we need to examine the structures built within those locations. Some are individual garages, some are multi-level parking structures, some were designed for emergencies, some were designed for retirement, some were designed to manage risk, and one government structure is built into nearly every worker's paycheck, whether they chose it or not.
Nobody drives past the government garage.
Social Security and Medicare taxes are collected before most workers ever see their paychecks.
They assigned me a parking space before I even had a driver's license.
And this is where the civic connection matters. Interest rate policy does not happen in isolation. Employment data matters. Inflation data matters. Federal Reserve appointments matter. Congressional policy matters. Government spending matters. And elections matter. These decisions help shape the environment in which every one of our financial structures must operate.
So while folks are saying, I don't follow all that political and economic stuff, all that political and economic stuff is following their mortgage, their pension, their savings, their business loan, and their retirement account.
That's why financial education cannot stop at open an account. You need to understand what kind of structure you open, what it was designed to hold, what rules govern it, how you gain access to it, and how it fits with the rest of what you are building.
Because a pile of accounts ain't automatically a plan.
And Scripture has quite a bit to say about building with wisdom, assigning different functions, and fitting separate parts into one complete structure. Proverbs chapter 24, verses 3 and 4 says, "Through wisdom is an house builded, and by understanding it is established. And by knowledge shall the chambers be filled, with all precious and pleasant riches." That is financial architecture. The house is built through wisdom. It is established through understanding, and its individual chambers are filled through knowledge. Notice the order. You do not begin by randomly filling rooms. You first understand what you are building. Then you establish the structure. Then each chamber can serve its intended purpose.
And Ecclesiastes chapter 11, verse 2 says, "Give a portion to 7 and also to 8. For thou knowest not what evil shall be upon the earth." That scripture already knew life be lifing.
Harold's,
The scripture says you don't know what could happen. So don't build your entire life around one paycheck, one account, one employer, one source of income, or one person promising they got you. Because jobs disappear, companies close, markets fall, people get sick, rates change, policies change, and family members who swore they were going to help might be living 3 states away with a newborn when the crisis actually happens.
that was harsh.
But was it inaccurate?
Anywho, the principle is not merely to scatter money everywhere without thought. It is to recognize uncertainty and prepare through intentional distribution. One structure may provide liquidity, another may provide retirement income, another may provide growth, another may provide protection, another may provide healthcare funding. The structures are not competing simply because they serve different purposes. They are supposed to work together, which brings us to Ephesians chapter 2, verse 21. "In whom all the building fitly framed together groweth unto an holy temple in the Lord." The passage is describing the body of believers as a building, with the separate parts fitted together into one complete structure. And that is
Thank
the
you for your
principle I
light,
want us to
for
carry
the breath
into
in my
today's
lungs,
financial
for the
discussion.
peace that steadies
Having
my
several
heart.
accounts does
I
not
rest in your
necessarily
presence.
mean you
Let
have
every
consulted
step
an
I take
architect
honor you.
and you consciously know
Amen.
what you are building.
You might just have financial clutter.
That too. And a state exists when the separate parts are intentionally fitted together. The rainy day garage has a function. The employer-sponsored parking structure has a function. The IRA garage has a function. The non-qualified garage has a function. The risk management structure has a function. And the government structure has a function, whether Harold appreciates his assigned parking space or not.
I would appreciate it more if Valet brought the money back with interest.
The goal is not to make every structure the same size. The goal is to build each one to fit your retirement goals, to populate your estate.
Meaning you don't put the lawnmower in the kitchen, the refrigerator in the bedroom, and the emergency fund in a 30-year investment.
Now you're cooking with Crisco.
You mean working with an architect?
And I walked into that one, but that is the point. Every financial structure should have a purpose. Your emergency reserve should not be expected to perform the same job as your retirement assets. Your retirement account should not be treated like your monthly spending account. Your insurance structure should not be judged solely by the same standards as a growth investment. Different chambers, different functions, one financial estate. Which brings us to a financial myth that keeps a lot of people from investing. You shouldn't invest in a brokerage account because you could lose everything tomorrow.
Well, can't you?
You can lose money on an investment, but you do not lose money simply because the account is a brokerage account.
Then what is a brokerage account?
A brokerage account is an agreement between you and a third-party custodian. The custodian agrees to buy eligible investment vehicles on your behalf, sell them when instructed, hold them, record your ownership on its books, and report the activity associated with the account to the IRS.
So where does that fit into all these houses, garages, and neighborhoods?
Think of the brokerage account as an addition built onto the garage. It may be a 1-car addition, a 2-car addition, a 3-car addition, or a much larger addition with extra storage and an upstairs apartment.
Meaning the addition gives me space to hold more things.
And access to more functions. Inside that brokerage addition, the custodian may allow you to buy and hold stocks, bonds, exchange-traded funds, mutual funds, certificates of deposit, cash equivalents, options, and other eligible investment vehicles. The brokerage account does not determine whether those vehicles rise or fall in value.
So the addition did not devalue the structure?
No, the result depends on what you placed inside, how much of each item you own, how those holdings work together, and whether they fit the purpose of the overall structure. You could place inside a high-performance sports car, an old-school classic, an all-terrain vehicle, a bicycle, a lawnmower, roller skates, a canoe, a minivan, an RV, an arsenal, or a deep freezer.
That sounds less like a portfolio, and more like somebody cleaned out 3 houses.
The point is that 2 people can both have brokerage additions and own completely different things inside them. One person may have one speculative stock, another may hold diversified exchange-traded funds, another may hold bonds and cash equivalents, another may have options, company stock, mutual funds, and several different types of securities.
Same kind of addition, different contents.
And different quantities, because risk depends not only on what you own, but how many of each you own, how concentrated the holdings are, and what purpose each vehicle serves. A brokerage addition can be attached to different garages. It can be attached to an IRA garage, a Roth IRA garage, a non-qualified garage, or another eligible structure.
So the location and garage determine the rules, but the brokerage addition gives the custodian somewhere to record and manage the vehicles.
Now we're getting somewhere. Eligible customer accounts at a SIPC member brokerage firm may also receive protection if the brokerage firm fails and customer securities or cash are missing.
Like FDIC insurance at a bank?
Similar purpose and different system. FDIC may protect eligible bank deposits. NCUA may protect eligible credit union share accounts. SIPC may protect eligible brokerage customer assets if a member firm fails. But SIPC does not insure you against market losses. It does not replace money because an investment declined, because you selected a risky security, or because a company became worthless.
So it protects my ownership of the vehicle, not the vehicle's resale value.
That is the distinction. Whether you lose everything or not has little to do with the brokerage addition itself. It has everything to do with what you placed inside, how much of each you own, how diversified the holdings are, how long you intend to hold them, and whether the vehicles match the purpose of the garage they are attached to.
So blaming the brokerage account is like blaming the addition because somebody filled it with Columbia House cassettes and Blockbuster videos.
That may be the clearest thing you've said all day.
Harold said what Harold said.
And apparently put it on a shirt. Dana Mitchell. I'm a little parched. Anywho, next we're going inside each structure. The government parking structure, the employer-sponsored parking structure, the rainy day garage, the IRA garage, the non-qualified garage, and the risk management structure. Dana Mitchell. We're going to explain what each was designed to do, what belongs inside, what rules govern access, and where a brokerage addition may fit into the overall architecture. Harold Tate. Now I need a pick-me-up. Dana Mitchell. because this construction project is going to require supervision, Harold Tate, and a permit.
All right, before Dana turns this into a full financial revival, let's take a coffee break.
And honestly, if you're trying to keep up with markets, policy, and all the ways money moves, you need to stay sharp. That's why I like strong coffee. It's not just coffee for a quick jolt, and it's built to help you stay focused and steady without feeling all over the place later.
Which is useful, because this economy already got enough people feeling jittery.
Exactly. So if you want to try it for yourself, use code WKBBW. That's code WKBBW. Same coffee, less money. Also,
Stay awake, stay aware. And now let's get back to it.
as I was saying before, this strong coffee, having several accounts does not automatically mean you have an architecture designed to support your retirement needs nor goals.
You might just own property all over, with no blueprint, no permits, and no idea who got the keys.
Which is why today we are examining the actual structures, not the tax location, not the investment vehicles. The structures designed to hold, organize, protect, and give you access to different parts of your financial estate.
So last week was the neighborhood, this week is the building.
Now you are following the blueprint. We will start with the structure almost every worker enters, whether they consciously chose it or not, the government parking structure.
Nobody drives past the government garage.
Social Security and Medicare taxes are generally withheld from employment income before workers receive their paychecks.
They assigned me a parking space before I had a driver's license.
Social Security was designed to provide a foundation of retirement income, along with disability and survivor benefits. Medicare was designed to provide health insurance coverage for eligible individuals, primarily later in life. These programs were not designed to replace every dollar of your working income, cover every health care expense, or serve as your complete retirement plans.
So the government garage is foundational parking, not luxury storage.
That is one way to put it. And because participation is largely mandatory for covered workers, most people already have some space in this structure. The problem is making that assigned space your entire estate. That assumes this one structure that you have contributed 7.65% of your lifetime income into will somehow magically become enough to fund your retirement.
Did you just say 7.65%? Wow.
That puts it into perspective, doesn't it? Next is the employer-sponsored parking structure. This is usually a larger structure with different levels, different access rules, different contribution limits, and different benefits depending on the employer and the plan.
You better remember what floor you parked on, which vehicle you drove, and whether your badge still works after you leave the company.
Very true. After several job changes, people might have multiple vehicles parked in this structure.
And after a lifetime of work, sometimes we forget what's there.
Defined benefit pension plans, defined contribution plans, 401k, 403b, 457 plans, and certain deferred compensation arrangements.
Same building, different floors.
And each floor was designed differently. A defined benefit plan generally promises a future benefit based on a formula. Years of service, earnings history, age, and the specific plan rules may all matter.
That is the floor where the employer tells you what the future parking benefit should be.
Assuming the plan remains properly funded and the benefit is payable under its rules. A defined contribution plan works differently. The account balance depends on what goes in, what the employer contributes, what investment vehicles are selected, fees, market performance, and how long the money remains invested.
So the employer reserved my spot and determined the shape of my vehicle.
Yep, but the size is determined by how much was contributed. Now, there are other floors in this structure. The 401k is commonly associated with private sector employers. The 403b is often associated with public schools, certain nonprofit organizations, and similar employers. The 457 is often associated with state and local government workers and some tax-exempt organizations. Deferred compensation arrangements may allow income earned today to be paid later under specific plan rules. And some plans include employer matching contributions. That is compensation, not charity, not a bonus somebody may remember to give you later. Compensation.
So not taking advantage of the company match is like giving up part of your paycheck?
It is saying no thank you to the money set aside for you. Of course, you need to understand the vesting rules, fees, investment choices, and access restrictions.
There are always rules.
There are always rules. The employer-sponsored structure was designed primarily to help workers accumulate retirement assets through payroll deductions, employer contributions, or both. It was not designed to be your everyday checking account. It was not designed to solve every emergency. And it should not be the only structure within your financial estate. Which brings us to the rainy day garage.
Finally, a garage, I understand.
This structure is designed for liquidity, emergency access, short-term needs, unexpected expenses, and financial breathing room.
This is where the transmission money lives.
The transmission, the furnace, the deductible, the emergency flight, the temporary job loss, and whatever else life decides to throw through the window.
Life does not knock.
No, it usually lets itself in.
So the rainy day garage got Old Faithful that we drive in the winter and the second car we use when the main one breaks down.
Great analogy, Harold. That means the primary concerns are often safety, liquidity, access.
So you probably shouldn't pay storage fees.
That's right. The garage must fit the job. Next is the IRA garage. IRA stands for Individual Retirement Arrangement.
Not investment?
Not investment. It is a retirement structure. Common versions include traditional Roth, the SEP, and the simple IRA. The garage itself establishes the rules for contributions, limits and tax deferral status, eligibility, who and when, withdrawals, when, how old, minimums, beneficiaries, eligible persons or entities, tax treatment of account growth, and how the account interacts with retirement law.
I remember we discussed in the last episode how the location determines tax treatment of withdrawals. Traditional IRA garages sit in Taxable City. The Roth IRA garage is in tax-free land.
Yes. SEP and simple IRAs were designed primarily for certain business owners and small employers, so they are customarily built in Taxable City.
Same general garage family, different building codes.
That is the distinction. Then we have the non-qualified garage.
Meaning it did not qualify for what?
It is not operating under the special retirement plan rules that govern qualified or tax-advantaged retirement structures. It is generally designed for flexible wealth accumulation, general investing, and access without retirement age restrictions. A non-qualified brokerage structure normally sits in the partially taxed suburb, where your basis was generally funded with money that had already been taxed, and where interest and dividends may create taxable income each year.
Even if the dividends got reinvested?
Even if the dividends were automatically reinvested.
So the account made money, put the money right back to work, and the tax bill came to my house.
Which means the tax may need to be paid from your paycheck, your savings, or another outside source. But let me reinforce what was said last episode. Capital appreciation is different. An increase in value is generally unrealized until the investment is sold.
Meaning the profit is still on paper.
Until the sale creates a realized gain or loss.
That's when the holding period matters.
Knock me over with a feather. Harold is correct. Short-term and long-term capital gains may receive different tax treatment. The same non-qualified structure may therefore hold already taxed basis, annually taxable interest, annually taxable dividends, unrealized growth, and realized gains or losses.
Partially taxed suburb.
That is where it lives. But remember, the tax location does not determine whether the investments are safe or risky. The vehicles inside determine the investment exposure. The quantities determine concentration. And the way those holdings work together determines the overall portfolio behavior. The next structure was designed less around accumulation and more around protection. The risk management structure.
The building everybody ignores until something catches fire.
Pretty much. This structure may include health savings accounts, life insurance, long-term care coverage, disability insurance, and other tools designed to transfer, absorb, or prepare for specific financial risks. The health savings account, or HSA, was designed to help eligible individuals save and pay for qualified medical expenses.
And depending on how it is used, it can live in tax-free land.
There you go, impressing me again. Contributions may receive favorable tax treatment, growth may accumulate tax-deferred, and qualified medical withdrawals may be tax-free. But the HSA is not simply another general spending account. It was designed for healthcare funding. Variable Universal Life Insurance, or VUL, combines life insurance protection with investment subaccounts. Its primary structure is still insurance. It includes insurance costs, policy charges, underwriting and death benefit rules, cash value mechanics, and market exposure through the selected subaccounts.
So judging it like a plain mutual fund misses half the building.
More than half. Long-term care coverage was designed to address the financial risk of needing extended assistance with daily living. As we fully covered in the long-term care episode, risk management is how you keep one event from forcing the sale of the rest of the estate.
Meaning the protection structure stands between the storm and the garages.
That is its job. And because each tool addresses a different risk, you cannot evaluate any of them by asking only, how much did it cost? You have to determine the real benefit of the loss that did not spread. Now that we have walked through the structures, let's return to the brokerage edition.
1 car, 2 car, 3 car, upstairs apartment.
The size of the addition is not literal. It represents the range of permitted assets, services, features, and account capabilities offered by the custodian. A basic brokerage addition may provide access to stocks, bonds, ETFs, mutual funds, cash, and certificates of deposit. A larger or more specialized arrangement may allow options, margin, managed portfolios, alternative investments, or additional planning and reporting services.
So 2 people can both say, I have a brokerage account, but they're attached to different garages in different locations.
Different registrations, different locations, different vehicles, different quantities, and different risks, different fees, different access, different purposes, and securities held through the brokerage are commonly registered in street name. The brokerage firm or its nominee appears as the registered owner, while the customer remains the beneficial owner on the firm's records.
They hold the paperwork. I own the vehicle.
And if the firm is a SIPC member, eligible customer cash and securities may receive protection if the firm fails and assets are missing.
But not if my sports car loses value.
SIPC protects the custody relationship under qualifying circumstances. It does not protect against market losses, bad investments, poor diversification, or unrealistic expectations.
So whether I lose everything depends on what I parked, how many I parked, and whether I knew how to drive any of it.
And whether those vehicles belonged in that garage, in that location, for your time horizon and your risk tolerance and your financial goals. And that is the aha moment. Most people do not have a shortage of account names. They have a shortage of architecture.
A checking account over here, an old 401k over there, 2 savings accounts with $9 between them, a life insurance policy nobody understands, and a brokerage app with half a share of something.
Financial clutter is not the same thing as a financial estate. An estate begins to take shape when each structure is chosen intentionally, assigned a purpose, placed in the proper location, and populated with vehicles that fit the goal. The government parking structure provides a foundation. The employer-sponsored structure supports workplace retirement accumulation. The rainy day garage provides liquidity. The IRA garage provides individual retirement structure. The non-qualified garage provides flexibility and general wealth accumulation. The risk management structure protects against events that could damage everything else. And the brokerage addition may be attached to several of those structures. allowing a custodian to hold and manage the investment vehicles inside.
So one account is not a plan.
And 6 unrelated accounts are not necessarily a plan either. The strength comes from knowing what each structure was built to do, what belongs inside, what rules apply, how the separate pieces interact, and whether the entire estate supports the life you said you wanted in retirement. So this week, conduct a structural inventory, list every financial account and policy you currently own.
Your checking accounts, savings accounts, employer retirement plans, IRAs, non-qualified accounts,
HSAs, life insurance policies, long-term care coverage, and anything else holding, protecting, or directing part of your financial life. Then ask 4 questions about each one. What structure is this? What was it designed to do? And how does it support my retirement plan?
And if I cannot answer,
Do not panic. Do not close anything.
don't move money because somebody on social media yelled tax-free.
No. Start learning. Read the account statement, review the plan documents, identify the custodian, check the beneficiary designation, understand the fees, and determine whether the structure still serves your purposes today, no matter the original reason for which it was opened.
Because the garage somebody, I ain't saying who, built for 25-year-old me, might not fit what future me actually needs.
And the estate should evolve as your life, responsibilities, resources, and retirement goals evolve.
We finally discussing the vehicles?
Stocks, bonds, ETFs, mutual funds, cash equivalents, and how many of each belong in the estate.
About time. I have been standing in this garage for 2 episodes.
Then finish your structural inventory,
Future me blowing my phone up.
probably to tell you to save gas and ride a bike.
Present me as screening calls.
So here's the truth. Wealth inequality isn't always about effort, it's about structure. And once you understand the structure, you stop being confused by the outcome.
And start moving different.
Exactly.
All this talk about systems got me tired.
Tired, or just worn out from fighting reality.
Both.
Well, when it's time to actually rest, I'm reaching for my cozy earth sheets because after a long day like this, comfort isn't optional. These are made from viscose, from bamboo, super soft, breathable, and honestly, once you lay down, you're not getting back up. If you're going to recharge, you might as well do it right. Go to cozyearth.com. Use code WKBBW. Get 40% off. Wrap yourself in luxury.
Yeah, I'm logging off early tonight.
If this episode helped bring clarity, stay with us. Follow the show. Share it with someone who needs it. This show exists to shine a light on the knowledge our community has believed was hidden so we can understand it and use it to our advantage.
Because once you understand the rules,
You stop guessing. Pray, plan, prosper on purpose.
share this with somebody who needs receipts.
Who keeps blocking black wealth? We digging deep to free ourselves. Faith, money, truth on the shelf. Let's talk about it, talk about it.
Who keeps blocking black wealth?
Not me, not today.
Check your credit and pray.